And for more on this, we are joined in Hong Kong by Hong Hao, who is the Managing Director and Head of the Research at the Bocom International. In Washington, D.C., we have Nicholas Lardy, Senior Fellow at the Peterson Institute for International Economics. In Irvine, we have Dan McClory, Managing Director and Head of China for Boustead Securities. Welcome, gentlemen, to our program. I want to start with you, Mr. Hong. Exactly what does it mean?
Well, in the short run, it means that China could soon become part of the international market. And already, even though we're seeing the overall index has a rather muted response to the inclusion, but if you look at the larger cap index within this market, I actually had a very good performance yesterday. And continuing on to this morning until in the late afternoon trading.
But we don't want to go into the details of how the stock market is functioning every day. My question more is about really the general trend. What does this mean, this specific decision by one index, and will in the future be contagious to the others? And what about the opening up of China's stock market? Is it really the start already? Mr. Hong, very briefly from you.
Yeah, I think it's a right step in the right direction. Even though the initial inclusion is very small, it's only 0.7%. I think most people are looking into the long run because this is really starting a process of being formally included in a much larger part of the global market.
Right, Mr. McClory, if I could go to you for your opinion, how long a run are we really looking at when it comes to the opening up of China's stock market to the international market?
Well, let's face it, this is not yet a certification, it's really a test. And if we use Korea as a proxy, that was a period of somewhere between 8 and 10 years till they became fully vested with all their constituents in the index. And just like so many other milestone achievements for China, as you've mentioned earlier, whether it's ascension to the WTO, inclusion in the world basket of reserve currencies, the MSCI is just another accomplishment that China is going to continue to have to work hard at every single day. This is being metered out on a very slow basis. Again, I use the word test. I think it's a watershed event, make no mistake about that. But this is going to happen over time. And the world is looking for China to make sure they've opened their capital markets with transparency and inclusion and free flow of capital, and the suspensions of shares that take place so often are another concern that MSCI has pointed out. And I think China, just like with WTO and the world reserve currency status, I think it's going to be up to the task, and I think it will conform and therefore become a major part of the index over the next decade.
Mr. McClory, I have to say, you're very optimistic. Let's go to Mr. Lardy. Mr. McClory, give us a very long list of what will be done and what could be done and what should be done. Mr. Lardy, of course, there is an issue of speed and pace, and in China, reform is being done over time. In recent years, it has been quite with some reason, if I could use a diplomatic word. Mr. Lardy, what do you think about the so-called long term?
Well, I think the inclusion of these stocks in the index is a potential important turning point. It's not really the opening of the market to foreign investors. The market has been open through several other mechanisms for quite a few years, but the foreign take-up of these channels has been much less than was anticipated for a variety of reasons. Getting some of these stocks included in the MSCI Emerging Market Index means that the money managers, the investors that have index funds, tracker funds, will have to buy Chinese stocks, at least in some limited amounts, if they want to keep their portfolios in line with the index. So it's a gradual process. I do think it will put pressure on the Chinese to improve the management of their markets, to not have many suspensions as they've had in the past, and to have them for very short periods of time. The main problem that foreign investors feel with respect to the market, I think, really is liquidity. In 2015, when half the shares were suspended from trading, sometimes for months, if you're running a fund, you don't want to be locked into a position and have no recourse. So I think this will be a gradual process. The number of stocks included should expand over time. And I think it will if China continues to reform its markets.
Mr. Hong, I want to go to you, and please give us a direct answer about that. I mean, when you think about China's opening up process, let's just say this, if compared to WTO, the Chinese economy then was much smaller, and it was playing a much smaller role in the international economy. Now it's a very different picture. So China probably, as the Chinese see it, have to keep a pace for itself rather than what they did with the WTO more than a decade ago. What do you make about that argument? And what do you think should be that pace, as they say?
Yeah, well, I think, if initially we include a very large portion of the Chinese market into the global index, I think it would actually suck out a lot of liquidity in the global system. It would be almost equivalent, like having a huge IPO internationally. Historically, when you have a huge IPO coming up, and at the time when liquidity is actually being reduced by central banks, that doesn't work well for the international market. So I would say that for the global market's sake, and also for the Chinese market's sake, it is actually good to have a gradual approach to open up this market.
But the question is how gradual, right? I mean, you can say gradual or gradual, right? There are different ways of saying it and doing it. So, Mr. Hong, what about your opinion about that?
Yeah, I think, well, let's use QFII as an example. Now it's a major player in the Chinese domestic market. Now the QFII funds is about 15% of the Chinese domestic market. And the process of development for QFII fund is well over 10 years. So I wouldn't be surprised to see a sort of a similar pace for the MSCI inclusion as well.
All right, Mr. Lardy, what about 10 years? Are you going to be happy about that? 10 years, let's just talk about.
I think it's, the path will depend on the pace of reform in China. If they continue to reform their market practices, have more transparency, more information, I think it could be much faster than 10 years. If they slip backward, these stocks could be taken out of the index at some point. Remember, the MSCI decisions on whether or not to include stocks in the index is driven entirely by the big investors. The big global investors are asked to give opinions, and if they're against the inclusion of stocks, they won't go into the index. So this is not necessarily a one-way street. Some of these stocks could be taken out. So I think you can't really predict how fast it will happen. It depends on your view about the underlying pace of reform of financial markets in China.
That's very true. In fact, some have predicted, of course, that's only a reference number, $500 billion US going to be flowing foreign capital into the Chinese market as a result of this inclusion. Mr. McClory, of course, for you guys who have been dealing with money every day on a big basis, 500 billion is not that big a word or big a number yet. Do you think this might give some kinds of momentum for China to act even more efficiently about the reform of its financial system? Or China is too big these days, it would just not having an impact at all about China's own agenda?
I think it will have an impact. Certainly when you look at a $7 trillion equity market capitalization for China, and even you use that number of half a trillion or 500 billion, which is about double the number that Goldman Sachs has put on the inflows that are expected. They say about 230 billion. But I think it's material and I think it's significant. And combining what Mr. Howe and Mr. Lardy have said, when there have been points and moments of stress in the Chinese stock market, liquidity has dried up very quickly. And China almost regards the stock market as a zero-sum game. So IPOs, for example, are heavily regulated and are not brought to market with the same frequency that you might see elsewhere, or consistency. So if there's an additional source of liquidity at whatever level that comes into that market, that's a positive. I think that's going to be a net benefit. And again, providing that there are free flows of capital, that the Hong Kong Connect actually works, and that these suspensions are put under control, I think this could all come together for a very nice evolution of the Chinese capital markets, with both the carrot and potentially the stick that are out there, and the result will be China's coming out into the world through its stock exchanges.
Well, once again, a long list of things that could happen coming from Mr. McClory. China's stock market ranks, as we know, and you argued earlier, gentlemen, second in the world in market capitalization behind the United States, and the stock market in China has become one of the most active markets in the world. But A shares only account for 0.7% of the MSCI emerging market index when included. Yet that is not the most important thing. The most important thing is, and I want to go to you, Mr. Hong, about that. We all know there is a lot of issues of printing money for the Chinese economy. There is also a lot of issues of liquidity on the other hand. So, of course, the Chinese economy is not going to depend on how the stock market is going to work. It's going to depend on how these real factors of the economy are going to work for the near future. Mr. Hong, about those and how those factors will eventually feed the growth of the stock market, particularly the healthy growth of the stock market, Mr. Hong.
Yeah, well, I think the Chinese stock market has grown tremendously over the past 20 years, and now it's 50 trillion yuan in market capitalization, and also we're dealing with a domestic economy that has M2 money supply at 160 trillion yuan. So there's plenty of liquidity in this system. So the Chinese market has its own depths, and as you pointed out earlier, the daily trading volume in this market is actually the highest in the world. So whether we include this index or not, the Chinese market is actually trading and well self-contained by itself. So I think going forward, being part of the global index, the weight within this MSCI global index can be substantially larger than 0.7%. I think theoretically we can constitute up to 30% of the global index.
Well, that is well argued. And yet my point, as you may have found out, Mr. Lardy, is what about the most important elements of the Chinese economy, the fundamentals of the Chinese economy, and how is that likely to interact with the healthy development of the Chinese stock market? When it comes to health of the Chinese economy, I'm talking about whether we're going to print money for the future in such a big amount, and also the huge amount of liquidity in the market and what to deal with it. These, of course, are the challenges the Chinese economy is dealing with right now, but how is it doing? How is it going to interact with the stock market? Mr. Lardy.
Well, one of the shortcomings of the market is that it is still dominated by big state companies, and the major source of growth in China in the last decade has been the expansion of private companies. They're producing most of the growth of the economy, most of the growth of employment, most of the growth of exports is coming out of the private sector. But there are relatively few private firms listed on the market. So I would think one thing we should look forward to as we anticipate the evolution of the market is that more private companies should be listed. And I think external investors would be quite interested in having more exposure to this dynamic portion of the private economy. What they're getting today through the inclusion of these 200 stocks through the MSCI index is, they're getting a disproportional representation of big state companies. So the driving companies and services and consumption are increasingly private companies.
All right.
More of them should be listed, and international investors should have more access to those.
Right. Mr. Hong, what about that argument? More private ones and more international companies get involved in China's stock market and also in the overall Chinese economy. Do you think that is what the issues are? Or actually what I put forward to you, which is about the fundamentals of the Chinese economy, both how to do with overflow of the currency and also the real growth of the economy?
Yeah, well, I think the stock market has played a very important role in financing the economic growth in China. But over time, one of the biggest problems that we're facing, or one of the challenges that we're facing, is really, in this economy we are well over leveraged. We borrow too much. Debt to GDP ratio is close to 300%, and most importantly, over the last couple of years since the global financial crisis, leverage within the Chinese system has gone up substantially, and now the corporate sector is heavily indebted. Internationally, we do need to do more. I think over the past number of years, we've been trying to develop an international board, but that has not been successful because every time this news come up, the B share market within the Chinese market actually plunged 5-7% within a day. Because international board is being seen as a way to divert liquidity flow from the existing stocks. So with a global inclusion, with potentially more and more global liquidity flowing into the Chinese system, we could be able to have enough liquidity to develop international board for international companies to come listing in China.
And final words from you, Mr. Lardy, how to also, on the other hand, China to avoid the risk as a result of being included into the international market, or the other way around?
Well, as I said before, I think the way to minimize the risks is to have more transparency, more disclosure, more analysis of these stocks. One of the limitations now for international investors is that there are very few stocks, relatively speaking, that are being covered by the international investment banks like Morgan Stanley or HSBC.
Right.
I think investors need more visibility on the companies that are being offered through the index and through other companies that may enter the index in the future.
All right. Mr. McClory, very final words from you. We only got 20 seconds for you, sir.
Sure. Well, I want to pick up on that point about the disconnect between the representation in the index and China's economy and its future growth prospects. 2/3 of the companies are local or national state-owned enterprises, okay? And over half are industrials and financial services.
Right.
That's really the was. We should be focused on the is and what China is going to be doing moving forward. And I think as those companies find their way in the index, it'll be more representative of the growth pace of the new China.
I see. Dan McClory, Hong Hao, Nicholas Lardy, gentlemen, thank you so much.